Welcome back from the break. We were talking about the consolidation process and well, with the next slides, I would like to go into the organization of that consolidation process to look at some specialties, but we should know about those. So the first thing that we will have to look at is the harmonization of the year-end date. Well, when you have 50 companies in a group, then probably all should have the same year-end date. But what if you just acquired a new company and that new company has a different year-end date? So, well, you have to do something about it. And the problem is here, can you accept a subsidiary with a different reporting date, so with a different year-end rate? And the the rules are, according to IFRS 10, you will have to check whether the reporting date of the subsidiary is more than 3 months before or after the reporting date of the group. So if that is a yes, then the subsidiary has to set up interim financial statements. So they have to do they have to set up financial statements for that date when the consolidation is done. If it is in that reporting, let's say, window of 6 months, so 3 months before or after, so within that 6 month period, then, well, if setting up the interim financial statements is not possible, then you would have to eliminate significant transactions, or you have to do this. So the subsidiary has to adjust for those effects. Otherwise, if it is possible to set up financial statements for that interim year end, well, then they have to follow that rule. And well, if there are no significant transactions in between this 6 months window, then the financial statements of the subsidiary can be used without changes because there is nothing material going on. So the question could be easier. Can you use financial statements that were set up on a different date than the group year end? Well, the answer is, well, yes. You can use the financial statements without changes when there are no material transactions in that 6 month window. But if it is possible to set up interim financial statements on the year end of the group, then, well, the subsidiary has to do that. And what happens in practice? Well, most of the subsidiaries will have the same year end, and if not, they will set up an interim financial statement for that date, and in very seldom cases, the financial statements of a subsidiary will be used without changes. So if there is a dormant company and they have a different date and there is no operation going on, I think that's okay. And in theory, we would just, if it's not material, we would not consolidate those companies, although we know that we have to consolidate all the subsidiaries. Well, if it's not material, we will not talk about it. We will not include that in the consolidated financial statements because it is not material. Okay, but I think in theory, we know we have to use the same date for all the companies that will be included. So what about same accounting framework, uniform accounting policies? Well, that is what the standard asks for. So what is the problem here? Well, when we have local financial statements and we will have to modify the local financial statements and put those into what we call the package, then, well, what will we have to do? Well, think of a US subsidiary. Well, they are obviously following US GAAP. The German subsidiary, well, they have to set up their local financial statements, their single financial statements under German HGB. Well, the Vietnamese parent, what do they have to do? Well, they have to follow VAS. So this is really apple and bananas, right? So how to put that into one IFRS package? And that is what we do as auditors, or we help the companies doing this as auditors. Well, the companies have to set up the single financial statements, and we call that number one to distinguish it from the single financial statements number two, which go into the consolidation table. So when we here have the single financial statements one, they are based on local GAAP. They have probably different currencies. So here we have the US subsidiary using US dollar. The Germans would use the euro, and VAS, the Vietnamese companies would use the dong as a basis. So we would, from the single financial statements number one, which are based on local GAAP, based on local currency, we will transform this SFS1 into the single financial statements number two. And those single financial statements number two are based on group policies. They are based on a currency that is the reporting currency of the group. And so we don't add apples and bananas. We first transform the apples into bananas, and then we will allocate all the bananas to the group accounts. So that is the problem here, and the standard says in IFRS 10 B87, well, the local single financial statements have to be transformed using the group accounting policies. So they have to follow those accounting policies, and then you are able to add comparable amounts together. Okay, so we have to use an accounting framework, which is the same. And I think you understand that. So recognition and measurement should be in conformity with the group accounting policies. And when you modify the single statement into the single financial statement number one, which is the local financial statements, into the single financial statement number two, that is the that we call that in practice, we call this the package. And the package will be identified by the auditor and sent to the group auditor. So the group auditor can then take the package and include that into the consolidation table to check whether the consolidation of the group was done correctly. So when we talk about SFS1 in the practice, we call those the local financial statements. They are based on local GAAP, they are based on local currency. When we're talking about the package or single financial statements number two, those are based on group policies. They are based on the reporting currency that the group is using. So the modifications from SFS1 to 2 refer to recognition, measurement, presentation, and also currency issues. So FSS2 is the basis for the aggregation balance sheet and the aggregated income statement. Otherwise, we could not add apples and bananas. In most cases, differences between FSS1 and FSS2 will have an effect on the amount of equity shown in the balance sheet and the financial result for the period. So if you follow the group policies, you might show an income or a loss, so a profit or a loss when transferring from the local financial statements to the package. So you have some group adjustments, and those will affect or may affect retained earnings. So that is why in most cases, and I told you that already, in most cases, retained earnings of the group will be different because of those adjustments. All right, so during the first time consolidation of a subsidiary, well, the results will be recognized in equity with no effect on the income statement. So it's just a reclass during the first consolidation. In subsequent years, that will affect the current year because these will be recorded in income statement, and a repetition relating to prior years will be recorded in retained earnings. So you will have to check whether that effect of transferring the local financial statements to the package will have a result in the current period, or whether it relates to previous periods. So in that case, you will have to book against retained earnings. Otherwise, you would book the difference in income. But we will see how that works. I'm just doing the principles here so that later on you will see what it is in practice. And of course, don't forget my hobby. Don't forget deferred tax, because that has to be evaluated again. When you change the book values, of course, the difference to the tax book values may change, and therefore that will have an effect on deferred taxes also. All right, so that's the theory. Well, what about presentation? Well, in order to be able to add apples and apples and apples and bananas and bananas and bananas, you have to put apples and bananas in the right row. Okay, so you have to have a uniform balance sheet and a uniform income statement. So the position should be at the same in the same row. I think this is quite logical, but at least I have to mention it. So you have to designate same names and same items under the same row. So if you for instance put tangible or let's say machines in one row, and then you put land also in that row, then you add machines and land, which would not give the right result. So you have to use a uniform item designation, you have to use same rows, and then you have to allocate assets and liabilities in the correct rows. Same with expenses and income. So you have to use the same item designation also for expenses and income. And in practice, you will get a big consolidation handbook from the group, from the parent. They will exactly give instructions to the to the subsidiaries how to set up a package, which then will be included in the consolidation table. So accordingly, options. So if IFRS uses or gives a choice to the preparer of financial statements, then of course that choice must be uniformly exercised in the group. So that is also a question of the consolidation handbook, because in there the group, the parent, will define which option will be exercised how when there is an option under IFRS. So recognition, measurement, and presentation should be the same. And therefore, a lot of reclasses, summaries, breakdowns have to be performed to match the format of the consolidated financial statements. That mostly is done at the company level, at the entity level, because they will translate their local financial statements, the single financial statements number 1, into the package numbers, which is the single financial statement number 2. And in the end, that package should match the breakout of the balance sheet, the breakout of the income statement. So you have a line by line possibility of adding the same items in the same row. Okay, I think that is clear. And here is what I would call the consolidation process as an overview. So how do we go forward? Well, first we will have the trade accounts or the local accounts SFS1. So these are the separate financial statements in accordance with national law. Then there have to be some modifications. Which ones? Well, based on the group requirements, you have to adapt different recognition criteria. So maybe in the local accounts, you will not show any intangible assets because maybe to national law, self-developed intangibles may be accounted for or may not be shown in the single financial statements. So when under the company, the group accounting policies, intangibles will always be shown, then if in the national law, in the local financial statements, you don't show any intangibles, well, you have to put them in. And that would be one of the modifications. Maybe you have a different measurement. So maybe in the local financial statements, you allocate, you will show the inventory with the average value. And maybe under group policies, you will use the FIFO method. So you have to change the measurement of inventory to match with the group requirements. So of course, if that is not material, so there is not a big difference between those two measurements, then of course you would not do that. And in IFRS, you would not speak about it because it's not material, right? But in theory, you will have to change all the differences to the group requirements. In practice, we do this when it's when there is a material difference. Well, adjust disclosures. So maybe under national law, you don't have to have a big breakout. You just put everything together, and then you have to just disclosure, which is not so detailed. So if the group instructions say, well, you have to make a lot of details, well, then you have to adjust the disclosures. and then, of course, translate to the reporting currency. That is also one of the modifications of transforming the trade accounts 1 into trade accounts 2. So this is also called FSS2, which are the separate financial statements in accordance with group requirements. So remember, or be sure that you're still in the level of the separate financial statements for that group entity. It's a separate financial statement. It's not the group accounts, because we come to group accounts a little bit later. All right, so we have the single financial statements number 2 of that entity. This is following the reporting currency of the group. It is following the accounting policies of the group. So there might be some differences in here which go into retained earnings, or if it is affecting the period's income, it goes into the profit and loss account. So then we have a separate financial statements in accordance with group requirements, but then we have to do some more modifications, because we have to reevaluate all the assets of the subsidiaries, not of the parent, but of the subsidiaries, according to fair value. So at acquisition, the assets and liabilities are valued at fair value at their acquisition date, and that determines the net assets at acquisition. We have to calculate the goodwill in this case, and then using that revaluation method. This will then, so modifications 1 plus modifications 2 will lead us to the trade accounts number 3. So we would call that level of single financial statements with the Roman number 3. So these are the accounts ready for consolidation, or ready for the sum up to this, what was it, a summary column. Okay, and then we will aggregate those trade accounts number 3 and aggregate all assets, all liabilities, and equity components. And then we have a subtotal, as we had in this first example of Ghana. We had a subtotal, and then we will do the final consolidation process. And this final consolidation process includes 4 steps. First is equity consolidation. So we will eliminate the investment of the parent. We will eliminate that against the equity of the subsidiary. So we did that already in our first example. So you know what equity consolidation is. Then the second thing is we do a debt consolidation. We will look into the details later, but basically it is the elimination of a receivable of one of the group companies against a liability of another group company, because those in theory should match. You deliver some goods to another company within the group, so you have a receivable against that company, and the other company should show a liability as long as they have not paid. And when you get the money, well, you will book out the receivable. So in theory, there is no liability and receivable at the year end when those are paid. But, well, that's the problem of setting up a balance sheet. At the end, there might be a balance in both companies. So you have one receivable, one liability, and that is called debt consolidation. So you will just cross those things out because you don't have a receivable from the group's perspective. You don't have a receivable to the outside world. The group has no receivable, and on the other hand, it does not have a liability against the outside world. So we will just cross out those two items. Same thing with internal income and expense. If you have, if the parent rents out an office building to a subsidiaries, well, they will have rental income. And what does the subsidiary have? Well, they have rental expense. And in the income statement of the group, you will not show rental expense and rental income at the same time. You will just eliminate those two. And the same thing with elimination of unrealized profits. So if you sell inventory to another group company, you may realize a profit in your single financial statements. And that is correct. When you sell as a company goods to somebody else, to another company, then of course you have a realized profit, but only on the level of the single financial statement number one. When you go into the group, what you have done is you have sold from your right pocket to your left pocket. So you have sold something within the group, and you should not show profit on this transaction. Okay, and therefore you will eliminate that unrealized profit that is sitting in the inventory of the buyer within that group. Okay, so these are the 4 items that we have to look at in our final consolidation. And then the end is the group accounts, the consolidated financial statements. Question? Well, it sounds a bit complicated, but step by step we will go through. I wanted to give you an overview so that you know where you are and why this is necessary in the consolidation process to do all these things. All right. So let's have a look at the key messages. What did we want to see in this chapter was that we would understand that a group of company comprises as a minimum a parent and one subsidiary. Subsidiary is the entity that is controlled by the parent. Control will normally be achieved by the parent owning a majority of the ordinary shares in the subsidiary. Yes, we know there might be other contracts that fulfill the control requirements, but let's assume that this is, and I think mostly in the practice, this will also be true that if you have control when you have the majority of the ordinary shares. Of course, when it comes to structured entities and things like that, it will be different. So group accounts are prepared as if the group was a single entity. This reflects our principle substance over form, and assets and liabilities of the parent and the subsidiaries, or the single one, are aggregated in full. So even if the parent owns only 60% of the subsidiary, we will fully consolidate all the assets and all the liabilities, substance over form. And the parent's investment in the subsidiary and the subsidiary's equity are no group assets. So they are not there against the outside world. So they will have to be eliminated. And during that elimination, we will see that goodwill may arise on that consolidation process. Okay, so these were the key messages, and well, let's compare what Daimler and what Wiener Milk say about the principles of consolidation. So let's compare the pages 162 of the Daimler case. So let me just go to 162 and then, hello. Okay. And then I will open my screen. Open the screen for this one. Yep, here we are. So the principles of consolidation on page 162 in the Daimler report says, well, I can maybe make it a little bit bigger so that your eyes don't get worse. Consolidated financial statements include the financial statements of Daimler AG, so that is the parent company, and the financial statements of all subsidiaries, including structured entities which are directly or indirectly controlled by the parent. Control exists if the parent company has the power of decision over a subsidiary based on voting rights or other rights, if it participates in positive and negative variable returns from a subsidiary, and if it can affect these returns by its power of decision. Okay, so that is a brilliant decision, a brilliant description of what Daimler AG is doing during consolidation. I think the other things are clear. Let me just have a look. The financial statements, this is on the next page, financial statements of consolidated subsidiaries which are included in the consolidated financial statements are generally prepared as of the reporting date of the consolidated financial statements. So generally, so there might be some exceptions. The financial statements of Daimler AG and its subsidiaries included in the consolidated financial statements are prepared using uniform recognition and measurement principles. So we have seen that IFRS requires that. All intragroup assets and liabilities, equity, income, and expenses, as well as cash flows from transactions between those group entities are entirely eliminated in the course of the consolidation process. So I think that is what we expect from a correctly set up consolidated financial statements, and business combinations are accounted for using the purchase method. All right, I think that is clear. So I will close this now and go to the Wiener Milk. Oh, that works great. So 153, 153. Okay, so that is half of it. I think it's half of 153 is around 176, something like that. So notes should be on the next page. Principles, principle of so this is page, let me see, 153. Okay, so I'll make it a little bit bigger. So the basis of consolidation is set out here. Okay. So subsidiaries are those entities in which the group has control over financial and operating policies, generally evidenced by holding more than half of the voting rights, so more than 50%. In assessing control, exercisable potential voting rights are taken into account. Financial statements of the subsidiaries are included in the consolidated financial statements from the date that control commences until the date that control ceases. Yeah, I think that's it. Transactions eliminated on consolidation, intra-group balances, transactions, and any unrealized income and expenses arising from intra-group transactions are eliminated in preparing the consolidated financial statements. Unrealized gains and losses arising from transaction with associates are eliminated against the investment to the extent of the group's interest in the associate. Business combinations are accounted for using the acquisition method as at the acquisition date, which is the date on which control is transferred to the group. Control exists when the group has the power to govern the financial and operating policies of the entity so as to obtain benefits from its activities. In assessing control, potential voting rights that presently are exercisable are also taken into account. All right, I think that we see that that works similar. So I will just close the, and then share my screen again. Okay, so we have gotten some insight from the Daimler and from the Wiener Milk case, and we can clearly see that these principles of group accounting work in both in IFRS and BAS, although they're from the amounts, it will be, of course, a little bit different because measurement is different under VAS compared to IFRS. All right, so I think that is enough for chapter 2, and I will give you some room for questions. So do you have some questions, what you have heard and seen in chapter 2? You can just use chat for that. So if not, well, then we can go on and we can have a look at the accounting for business combination, which is IFRS 3, as you already know. So when we look into IFRS 3, we see that a business combination is a transaction or other event in which an acquirer obtains control of one or more businesses. So the acquirer can be called the investor, and if it has control, it will be called the parent. A business, what is that? Well, a business is an integrated set of activities and assets that is capable of being conducted and managed for the purpose of providing a return in the form of dividends, lower costs, or other economic benefits directly to investors or other owners, members, or participants. So it's probably a very long description for we just buy a company and expect that it runs well and pays some nice dividends, right? An entity shall determine whether a transaction or other event is a business combination by applying the definition in IFRS 3, which requires that the assets acquired and liabilities assumed constitute a business. If the assets acquired are not a business, the reporting entity shall account for the transaction or event as an asset acquisition. that is a difference between when you buy a company that is running, and it has customers, it has suppliers, and it has a process within the company of generating profits, then this is a business. When you only buy maybe the fixed assets of a company and assume some liabilities for that, this is not a business combination. That is what it says. So it does not have all the inputs and outputs of a normal company, and therefore you're not buying a business, you're not entering into a business combination. You are merely buying assets. So you can go to a shop and then buy a new machine. That is not a business combination because you don't have all the guys who are operating the machines, you don't have customers, and you're not buying these things. So you have to be aware whether it is really a business combination or it is a pure asset acquisition, even if maybe liabilities are involved in this acquisition. All right, so when we obtain a business, then we might obtain control. And well, that could be done in a variety of ways. So for instance, we could deliver cash, so we could pay cash, or we could pay with other assets that could be cash equivalents, so things that are very near to cash, like some what is it? Wertpapiere in German. Wertpapiere means equity instruments, financial instruments that are very near to cash, or other assets, including net assets that constitute a business. So you can do that in a variety of ways. You could also assume liabilities. So you don't have to pay cash now. You take over the liabilities, which you will have to pay later, but that is also can increase the cash or the means that you are paying for that business. You could also use your own equity to buy another company by issuing equity to the sellers of that company. So you could issue equity interest, or you could provide more than one type of consideration. So that means you can have a mixture of paying cash equivalents, and maybe incurring liabilities and issuing equity interest. So it could be a combination of those. And well, that could be with one contract or with several contracts that should be combined afterwards. So that is how you would look at the different considerations that a company would use for paying the acquisition price. So the purchase price can be made out of a lot of considerations. And when you then, as the acquirer, you have to account for that business combination, well, you have to use the so-called acquisition method. So first thing is you have to recognize the fair value for all of the things you get, because you don't pay for the book values. If you have a company that you are purchasing and that company has land sitting on the balance sheet, and the land was acquired 30 or 40 years ago, so you might understand that the book value of the land is not the fair value of that land. In the meantime, the land has increased considerably when it compared to that time when you bought it 30 or 40 years ago. So the fair value of that land would be quite higher. So when you look at the acquisition method, that means that you have to value each and every item that you buy in a business combination at the fair value. You will not use the book value because that value is of no use. So what do you have to do in the acquisition method? You have to identify the acquirer. So normally it is the bigger one who buys the smaller one, right? So that's normal, but there could be an inverse acquisition. Forget that completely. We will not look at that, but this is why this is important. You have to identify the acquirer. It might be in practice the acquired company that is acquiring the parent. So you have an inverse or a reverse acquisition, but that's a problem that maybe arise in your future career, but not in this course here. So you have to identify the acquirer. That's easy part for us. Determining the acquisition date, well, that is also clear. We have to see whether it is whether there is a post-acquisition period in the year. And then we have to recognize and measure the identifiable assets acquired, the liabilities assumed, and any non-controlling interest of the acquiree or investee. And then recognize and measure goodwill or a gain from the bargain purchase, if there is any. Well, the IFRS business combination paragraph 16 tells us that the acquirer shall measure the identifiable assets acquired and the liabilities assumed at their acquisition date fair values. So that is the main principle of an acquisition, that you have to value those assets at fair value. And that also includes identifiable assets. So for instance, if the company that you are buying has not set up a provision for a restructuring because the formal prerequisites were not there, then they could not set up a provision. But during the process of buying that company, you would of course identify that that need to pay some money for the layoff people and to have some money set aside for removing or disposing fixed assets that are no longer needed. So you have to also measure those identifiable assets and also liabilities at fair value. So that means that there might be cases where there is no liability in the books of the acquired company. And when doing the acquisition accounting, you have to put a liability to the books at fair value. So that is also in the process of acquiring those companies. So this leads us to the question, well, what is the fair value of the investment in the subsidiary? So imagine you have a company, well, we will call it the investor, and the investor will pay a lot of money, a lot of other things to get the control of that company, which is acquired. And then you might have several possibilities to pay to the old shareholders. So we will look at these considerations with the following slides. Well, but first we have to understand that the fair value of the investment is something that first relates to the separate financial statement of the parent, because the parent is buying the other company. Okay, so the investment will be shown as one item, as we saw in our first example. You will show the purchase price of 300 in one line, and that is the investment. So in most cases, this investment will be shown under financial assets, because an investment in another company is a financial asset. So what is the valuation in the single financial statement? Well, it is cost. And that is equal to the fair value of the consideration paid at the acquisition date. So the buyer makes his own idea about what he or she is buying, and therefore he or she will put a value to the consideration that is paid at the acquisition date, and that is cost, right? So cost is the fair value at the acquisition date. And the valuation is at cost, and you will show, the investor will show the investment as part of its separate financial statements. So let's say the parent's single financial statements, and this will be at cost. Now, when it comes to the consolidated financial statements, we have learned that all assets and liabilities of the investment will be shown in the appropriate balance sheet or income statement captions, and all should be valued at fair value at the acquisition date. And that is sometimes difficult to understand, because here in the separate financial statements, the valuation is at cost. And in the consolidated financial statements, the same assets and liabilities that are included in the investment here, they will now have to be remeasured into fair value at the acquisition date. And that we will be doing during our next case study. So as a consequence, for the parent's single financial statements, we will have to find out the fair value of the consideration that is given by the investor for the shares of the investee. So that's the first thing. And we do that for the purpose of the single financial statements. And then for the purpose of the consolidated financial statements, we have to determine the fair values of all the assets and the fair values of all the liabilities of that subsidiary. So please understand, these are two steps. The first step is look at the parent's single financial statements. The second step is look at the consolidated financial statement of the group. All right. And well, maybe one more thing. In the single financial statements of the parents, it is only one line. So the investment will be shown in one line. In the consolidated financial statements, assets and liabilities are shown in all, or maybe shown in all lines. Okay, so that is also a big difference between single financial statements and consolidated financial statements. All right, so we talked about fair value. So what is fair? I think we all have a different understanding of what is fair. So I think there is a big discussion, or there was a big discussion about what is a fair value. And well, the standard setter IASB came out with IFRS 13, and they define fair value as the amount that one would receive when selling an asset, or has to pay to transfer or settle a liability in an orderly transaction between independent market participants at the measurement date. So I think that is clear, the amount of one would receive when selling an asset. So the fair value of an asset is what you get for it. The fair value of a liability is what you have to pay to get rid of it. And that should be in an orderly transaction. So if you have to sell, if you're near bankruptcy, then you have to sell below market to be able to get money. So that is not an orderly transaction. So you have to look at the situation at the company, and if it's selling that one in a normal operation, then we are talking about an orderly transaction. And those should be between independent market participants. So if somebody is going to hold a pistol to your head and saying, please sell me this car for $1 US, that is not independent, right? And they are not market participants. So that's a robbery. So yeah, that is one requisite. And it's also the measurement date that is relevant. It's not a different date. It is the one at which you will make that measurement. So in the end, that is the global definition. The IASB observed that there can be 3 levels from which you take the input for a fair value. So the easiest one is the level 1, because on that level, you will see quoted prices in active markets for identical assets or liabilities that the entity can access at the measurement date. So for instance, if you want to go, if you want to know the fair value of apples and bananas, you just go to the market and observe the market prices on that market. Or you want to know the fair value of a financial instrument, let's say, what is the value of a Vina milk share, you go to the listed stock price, maybe on the internet or in the Financial Times of Ho Chi Minh City or Saigon Financial Times, and you look into that one and you will find a fair value. So that is very easy. Where you have observable prices, you can easily determine the fair value. The second one is inputs that are other than quoted prices included within level 1 that are observable for the asset or liability, either directly or indirectly. So I think my best example for that is when you have rare earth like bauxite. Have you heard the name bauxite before? So bauxite is earth. It is digged in Australia, in Africa, and it contains aluminium in a very well, let's say 40% of that is aluminium. So when you take that earth and then dig away or extract the aluminium from that raw earth, then you can have aluminium, right? So when you know how much aluminum is in your bauxite, and you will not find a stock quoting for bauxite, but you will find the stock information for aluminum. So you go to aluminum, and then you know how much bauxite will go into 1 ton of aluminum, and then you can have a related quoted price, and then work back from the stock market for aluminum. Then you can work back to the fair value of the bauxite that you have. So it's not directly, you cannot directly see an input, but you have a related with a strong relation to that one. And I think that is level 2. So there is somebody, I said bauxite, yes. I hope that I pronounce it correctly. Bauxite is the earth that from which you make aluminium. Okay, do you have another good example for this one, for level 2? So somebody is writing. We're looking for another good example. Well, what about tooth gold? You have maybe 10 tooth, and well, I don't get the how can I explain that? Probably you inherited some tooth, and included in there there is some gold, and when you melt that gold down, then you maybe have gold which consists of let's say 65% pure gold. So there are other things in it, and so you don't have a quotation for 65% pure gold, but you have a quotation for 100% of gold. So you can have a direct relation. So that tooth gold would be the fair value for that tooth gold would be 65% of the 100% gold quotation. Okay. So that would be another one. All right, so level 3, and that is the most complicated, but it is used quite often in setting up financial statements. It is where you have no observable inputs for the assets or liabilities, and you will discount future cash flows into a present value. So for instance, if you want to, if you don't have a stock valuation for your investment, you might look at future revenues they have, look at the future expenses they have, put that on a time scale, and then discount those cash ins and cash outs, and calculate a present value of that, and then value your investment with that future discounted cash flows. So that would be level 3. You will get a fair value for that. But I think you will agree that the level 3 is very vague. It is dependent on a lot of assumptions. So what is the discount rate you use? What is the increase of future revenues? What is, and so on. Yeah. So I think level 1 is the best you could have, because it will give you a precise fair value. Level 2 is okay because it has some observable quoted prices and then makes a relation to that one. So it's quite strong. So this is very strong. This is quite strong. But level 3 is something that you should be really cautious with. And in practice, that is, well, often used by companies because you don't have quoted prices for all the assets they have. So they will use discounted cash flows, and that will be often a discussion with A, the auditor, or B, the authorities that will check whether the financial statements are correct or not. So, okay, that's enough for fair value and the fair value hierarchy, but we should know that before we enter into the next example. So here we are still on the level of the single financial statements, and we would like to find out what is the fair value of an investment. So we have learned that there could be several considerations. So we could have cash, we could not pay cash, or in addition to pay some cash, we could use our own shares as a payment mean. So we could use own shares. We could say, well, we will pay you something, but in 2 years. So we have a deferred consideration. That's a payment not effected at once, but deferred in the future. Then you could also say, okay, instead of paying something now, I would sign a loan note, and I will pay the loan later. And in the meantime, you also, the seller will enjoy interest, which is on those loan notes. And well, the last possibility of a consideration is a contingent consideration that is also found very often in contracts where you have a merger, because the buyer, of course, says, well, there are a lot of risks involved when I buy your company. And the shareholders of the old company, they say, or the old shareholders of the sold company, they say, well, our company is the best and it will produce profits in the future, and you pay so low price for that. So I think you can understand that there will be a lot of arguing. So one possibility to solve that is a contingent consideration. And it simply will say, well, the consideration can be dependent on uncertain future events. So if, for instance, the profit targets are met, then the price will increase. So they will pay consideration, which is contingent. So it is based on future profits. So if the contingency is met, so if the profit target is met, then they will increase, they will have to pay that price. If the if the contingency is not met, so the profit targets are lower than expected, then they will not have to pay that. So that is the principle of a contingent consideration. And those considerations can be paid in cash, can be settled in shares, and things like that. So you will see a lot of examples in the practice. So basically, that is how you would give a fair value to what you have paid. And I think that well, cash, you have to value these things now. And I think cash is easy. You just look on the bank account and you see what have you paid for that, and you put it as a component of your fair value in the last column. So that's easy, just the amount that you paid. So when you issue own shares, So what does that mean? Well, of course, you will give away, as a buyer, you will give away some of your own shares. So those should be valued at the market value of the shares at the acquisition date. Right, so it is something you give to the old shareholders of the company that you are acquiring, and you lose some of your own shares, and those should be, well, if listed, it will be the market value, the quoted price. Otherwise, if there is no stock listing of your own shares, then the investee has to make otherwise a valuation. So maybe use discounted cash flows. Okay, so but in principle it should be the fair values of those shares. The deferred consideration, well, that is an obligation in cash. So the present value of the future payment, so if it is paid in 2 years' time, you will have to discount that amount by 2 years. So you have the fair value of that payment in 2 years. I think that is also clear. Now it comes to the problem. I observed this in the exam, and I think also in practice, you have a lot of problems in understanding what to put here as a fair value. So you have interest-bearing loans. So that would mean that instead of paying something, you will pay it later. And in the meantime, this will be considered to be a loan. Now, what if the interest is at market, then it's the fair value is what the market value is. So you would just put the nominal amount as the fair value of your consideration. Okay. But if it's over or under the market, and that is always the problem in the exam, so it's not at market value, it's either over or under market, then you have to determine the fair value of those notes. And what you do in practice is that you will take the fair value of those interest-bearing loan notes and then put that on the in the last column. So you would determine what is the fair value of those loan-bearing notes, and not only include the nominal amount, but also the interest that you will have to pay, or, well, there might be a discount. If it's lower than market rate, then obviously you have a discount. Okay, and the consideration, the contingent consideration, well, you have to determine the fair value. That will be a problem to calculate that. So mostly in the exam, there will be a number given. So it's not a big deal. But in theory, you have to then calculate the probability of whether it will come or will not be, that this uncertain future event will be there or will not be there. So it's kind of a high educated guess what that contingent consideration will be. But I think all in all, when you add those components, you will receive the fair value of the investment. And that fair value is used to put an amount to the parent's single financial statements. So we are in the single financial statements of the parent and put this amount as a fair value, as a cost for that investment. Questions? No. So I think it's 11:30 my time, 4:30 your time. We will have a break of 1 hour, and then we will come back again and do a case study on this fair value calculation. Okay, so see you later.